All right, today we're going to break down a trading model called the daily sweep. The source material claims it's one of the simplest ways to find profitability and fast. It's a really straightforward three-step approach that's designed to cut through all the noise and give you a clear plan of action before the market even opens. So let's dive in. You know, for years, the trader who came up with this model said he'd open his charts every single morning and just feel completely lost. He'd have like 6 different time frames open, the daily, the 4-hour, the 1-hour, you name it. And the result was always the same, total paralysis by analysis. He was missing all the big moves because he was trying to look everywhere at once. I mean, does this sound familiar? I'm willing to bet it does for a lot of you. That feeling of just being overwhelmed, drowning in a sea of data points, indicators, and charts, all screaming for your attention. It's such a common struggle. But what if there was a way to just filter all of that out?
Now here's what's really interesting. The argument here is that the problem isn't a lack of knowledge or analysis, it's the lack of a system you actually trust. Because when you don't have a plan you truly believe in, that's when uncertainty creeps in. And what follows uncertainty? Anxiety. And before you know it, you're making decisions based on fear and greed, instead of a clear, objective plan.
So, what's the fix? Well, it's this simple 3-step model. The whole idea is that you develop your entire plan before the session even starts. This is all about eliminating the chaos by knowing exactly what you're looking for day in and day out. And it all breaks down into 3 parts: direction, confirmation, and precision. So let's jump right into the first step and see how this thing is built. Step 1 is all about finding your direction for the day. And it all starts with a really simple objective concept called swing points.
Okay, so what in the world is a swing point? It's actually super simple. It's just a 3-candle pattern. A swing low happens when a candle's low is lower than the lows of the candles on either side of it. And a swing high, yep, you guessed it, it's just the exact opposite.
And you can see it perfectly here. On the left, for that bullish swing point, that middle candle just pokes down a little bit lower. And on the right, for the bearish one, the middle candle's high is just a bit higher. The key here is that it's a completely objective pattern. It's either there or it isn't, no guesswork involved.
So, and this is crucial, by marking these points on your chart, you're literally creating a roadmap for the day. You're not just drawing random lines based on a gut feeling. You are objectively marking spots that are already printed, places where price has actually reversed in the past. Just doing this one thing alone gets rid of so much of the guesswork.
Okay, so you've got your roadmap. You know the key levels to watch. But, and this is a big but, you don't just trade them blindly. Now you need a specific confirmation signal to tell you it's time to act. And that brings us to step 2. And the source material is really blunt on this point. Simply buying at a swing low or shorting at a swing high without some kind of confirmation is, and I quote, financial suicide. It's just a recipe for disaster. There's a very specific pattern that shows up at these levels that changes the entire game. And that pattern is called the swing failure pattern, or SFP for short. Here's what it looks like. Price pokes through a previous swing high or low, just long enough to trick people and grab all that liquidity sitting there, but then it quickly fails and slams right back into the old range. It's a huge red flag that the breakout just failed and a reversal could be coming.
Now check out this number. Over 50%. What do you think that means?
It means that the second the author learned to spot this one specific pattern, his win rate jumped from around 35% all the way to over 50%. We're talking practically overnight. That's the kind of massive impact a reliable confirmation signal can have. And this isn't some hindsight thing. It's a pattern you can actually spot as it's happening. So you've got your direction, you've got your confirmation signal. The final piece of this puzzle is precision. How do you actually get into the trade without getting stopped out just seconds before the real move happens?
Well, this is when you finally and only now drop down to a lower time frame, like a 5-minute chart, to look for an entry model. Now, the source uses things like fair value gaps or order blocks, but he also makes it clear that other common tools like VWAP or even simple moving averages can work just as well for your entry.
And here's a really key takeaway. The specific entry model you decide to use, it's actually the least important part of this whole process. Now, why is that? Well, it's because a strong directional bias from step 1 and a high probability confirmation from step 2 have already given you a massive statistical edge. That edge means the whole trade is way less dependent on a perfect pinpoint entry. All the heavy lifting is already done.
Of course, even the best strategy in the world is totally useless without a rock-solid set of rules, right? This system has a very clear framework for managing your risk and, just as important, your timing.
The risk management is incredibly simple, and it's non-negotiable. You're always targeting a fixed risk to reward, either 1 to 2 or 1 to 3. You only get 1 or 2 attempts a day, tops. And if that first trade is a loser, you cut your risk in half for the second trade. This puts a hard cap on your maximum loss for the day at 1.5 times your initial risk. It's all about playing defense and protecting your capital.
Now, this next idea is huge. Time is more important than price. What on earth does that mean? It means you don't just take these setups whenever they pop up. You have to wait for specific high volatility windows, like the New York stock market open if you're trading something like the NASDAQ. Trying to trade outside of these key hours, according to the source, is just going to give you junk data.
So let's bring this all full circle. How does this simple 3-step process solve that initial problem we talked about? That feeling of being totally lost and overwhelmed?
Well, this slide just sums it up perfectly. Step 1, finding your direction with those objective swing points. It solves analysis paralysis. Step 2, waiting for that specific confirmation signal stops you from chasing price and just guessing. And step 3, using a precise entry model solves the classic problem of bad entries and messy stop losses. It really is a complete framework that takes you from total chaos to absolute clarity.
And that kind of leaves us with one final thought to chew on. When you strip away all the complexity, all the indicators, all the noise, could a simple, objective process just like this one be the key? Is it possible that the one thing standing between you and more consistent results isn't more information, but just a clearer, more disciplined plan? Definitely something to think about.